Hi. Hi, good morning, everyone. This is Benjamin here. Right, today there will be no macro and market outlook, and today I'll be running you guys through on the Singapore banking sector. Right. So first of all, some of the key agendas for today. First, whether net interest margins will recover going forward. Second point, how the loans growth of the Singapore banking sector fare for FY14. And thirdly, what are some of the key drivers that we should look out for going forward in FY14? And last of all, we'll conclude on why we prefer DBS and UOB over OCBC and why DBS still remains our top pick for the Singapore banking sector. So first of all, quick recap on how the banks have performed so far. All right, as you can see here, right, the NIMs, which is the net interest margins for the banks, have stabilized over the last 3 quarters, right, which have actually hit a historic low. So the NIM stabilizing is actually quite a pretty good sign. Okay, so if you examine the loan balances for the banks, we can see quite a healthy and strong growth momentum for the banks, especially in FY13. Alright, so the loans growth for FY13 for the Singapore banking sector should be expected to end around in the mid-teens region for FY13. Right, so strong loans growth, stabilized NIMs. So you can see that the net interest income is still growing for the banking sector despite the very low interest rate environment that we are facing. So going forward, what can you expect for FY14? Okay, QE tapering has been announced on December 18 by the US Fed. Right, as a result, you can see that the market has responded. The yield curves have been steepening. You can see the long-term interest rates have moved up quite a bit. Right, so we think that the banks could possibly take advantage of the widening spreads between the long-term as well as the short-term interest rates, and this could possibly result in them improving their net interest income. Right, so again, QE tapering is good news for the banks because we can see that expect that there'll be an interest rate cycle revival in the midterm, right, which is probably end FY14 onwards when the short-term rates start to move up. So that is when we expect the net interest margins, right, to start moving up and rising beyond such a low point. So in the near term, we don't expect short-term interest rates to move, okay, because the US Fed has actually promised to keep the interest rates environment low for the time being. So again, we expect net interest margins to recover gradually in the midterm, and with the NIMs recovering, we expect quite a strong lift to the earnings for the banks. Second key point, how will the loans growth fare? Again, strong loans growth momentum, as you can see. Okay, so the banks have actually guided for a high single-digit region growth for FY14. Okay, so basically what we think, okay, housing loans is expected to actually decrease, right, during the second half of 2014 onwards, right, because of the cooling measures in place. Okay, it has resulted in about 30 to 40% decrease in the mortgage originations. So because housing loans, right, typically take some time to draw down, so that is why it has estimated that the impact should be felt by the sector in second half of 2014. Okay, so we'll see that housing loans will create some drag on the overall loans growth, right? But on a positive note, what we think is that the very good macroeconomic environment for Singapore as well as the global markets should provide some upside to the loans growth. So you can see from the chart here, right? This is the GDP growth rate, right, for Singapore. So for the loans growth for the banks, it typically tracks the GDP growth by a couple of quarters, right? So from the fact that also that we are positive on Singapore GDP growth, right, it's a good proxy for the loans growth going forward, right? So I think it's not unreasonable that the banks are able to meet their target guidance of a high single-digit growth for the overall loans book. So next up, some of the key drivers to look out for in FY14. Again, fees and commission have been growing very nicely for the Singapore banking sector, as the banks are looking to focus more on this area, right? Because fees and commission generally is less capital intensive. It's a good source of income in a low interest rate environment. So the 3 key areas again that the banks are focusing on are wealth related, trade related, as well as loans related. So you can see for OCBC, the Bank of Singapore, the wealth management fees have been growing quite nicely, okay, together with loans related as well as the trade related income. So for DBS, very strong trade related income, and again wealth management as well as loans related. So for UOB, loans related is quite strong but a bit lumpy. And you can see this is investment related, which is actually wealth management for UOB, growing quite nicely as well. Okay. So some key factors again for FY14. Okay, QE tapering, the markets have responded very positively. So this means it's a good sign for the fees and commission for Singapore banking sector. And with a possibly good market direction going into FY14, okay, hopefully we can expect some positive impact on their net trading income, which hasn't been doing too well the last few quarters because of a lot of market volatility. And then from the continuous effects of QE tapering going forward, we expect some losses on their AFS portion, which they hold a lot of long-term securities. So for the last earnings release, the banks have stated that they're going to reduce their exposure for their long-term portfolios. Right, so let's see after the fourth quarter of FY13's results, how they actually have trimmed down on the exposure. So with the QE tapering, okay, we also expect the system liquidity to tighten as well. So with a crunch liquidity, we expect this to drive up the funding costs for the banking sector. Okay, but we think that the Singapore banking sector should be able to mitigate this because their CASA balances, which is the current account and saving account balances, forms a very strong deposit franchise for them. So this should help to lower the funding costs. On the regulatory front, MAS again is likely to finalize on their liquidity coverage ratio under Basel III, possibly in the first half of 2014, and they've been working quite closely together with our three banks. So we think that the impact should be minimal because the banks have been preparing their balance sheet for this new regulation in place. So last point, quite cautious on the ASEAN front. Right, Thailand is still facing a quite big political situation, probably up to February onwards. And the Indonesian economy is not doing as well as expected, right, with their current account still running a deficit. So we think that the overseas subsidiaries for banking sector might be affected. Right, so for FY13, you can see that the ASEAN currencies have been depreciating quite a bit, right, and this might go on into FY14. So upon consolidation, the results for the loans growth and fees and com might be impacted if we include the currency effects. So therefore, we expect a single-digit growth for FY14 going forward for the non-interest income as well as the fees and commission. So quick summary on the sector, why we prefer DBS and UOB over OCBC. For DBS, we maintain a cumulative rating for new target price of $19.09, but we like them for their highest exposure compared to its peers into Greater China through their DBS Hong Kong. Second, still holds the highest CASA deposits and has the most liquid SGD balance sheet. In terms of valuation, still trading at a discount compared to the other two banks. For UOB, we still maintain a cumulative rating. New target price is $23.03. Like them for their very stable and strong fees and commission they have shown so far, as well as the management pursuing the regionalization agenda, which results in them having a very stable overseas contributions. For OCBC, still maintain a neutral rating. The new target price is $10.62. Should we do like them for their good bank assurance model, right, together with Great Eastern, as well as Bank of Singapore helping them to grow their wealth management fees quite nicely. But however, OCBC earnings profile is quite volatile because of the exposure to the interest rates due to the insurance arm through Great Eastern. Right, so that's why we still maintain a neutral rating on OCBC. Moving on to why DBS remains our top pick for the Singapore banking sector. A quick snapshot. Again, last Friday's price ended at $17.03. Target price again, $19.09. So you can see DBS has been outperforming the STI over the last 1 year. Okay, quick company overview. Right, DBS net interest income for 9 months cumulative is 61% against the total income. Right, so it's about a couple of percentage points higher than its peers. And for the fees and commissions, forms up about 21% of total income. 4 key investment merits for DBS. So number 1, DBS is the best position to benefit the most when interest rates rise, as we discussed just now, right, when the interest rate cycles revive in the medium term. Second merit is that it has the highest exposure to Greater China from DBS Hong Kong. Right, so when believe that when China grows again, right, it's going to benefit the most. And thirdly, for valuation parts, trading 1.29 times PB now, around 1.3 times. So it's still at a discount to its peers. And lastly, still holds a very attractive and stable dividend yield of 3.3%. So for the first investment merit, why does DBS stand to benefit the most from rising interest rates? Again, we say that NIMs, we could see NIMs recovering in the medium term, right, when short-term interest rates move. Okay, so the bank that stands to benefit the most, right, is the one with the cheapest cost of funding. So we look at the CASA balances, which is the current accounts and saving account deposits, okay, against the total deposit ratio. You can see that DBS clearly stands out against the rest, which it has the highest CASA deposit ratio, right, in comparison. So therefore, DBS should be in the best position to take advantage when the interest rates move. Right, to elaborate a bit more, we also think that DBS has the most liquid SGD balance sheet, right, and maintains a very good efficiency as well. So if we look at the LDRs, which is the loan to deposit ratios for the banks, you can see that the banks are hitting a quite historic high, close to 90%. Right, so the LDRs are usually a balance between the liquidity of the bank as well as generating good efficiency from the deposits that they get. Right, so you can see the banks are increasingly becoming more efficient, but the question is whether are they squeezing the liquidity internally, right? So we dive in to look at a section that all the banks are going towards, which is trade-related loans, generally called the general commerce loans. You can see that DBS is growing at a much faster rate compared to its peers, right? So that's what's driving its loans growth. And then, so we know that for the trade-related loans, a lot of substantial portion of it is actually USD denominated loans. Right, so again, to prove this, let's go into the USD LDR. You can see in the blue line here, right, that for DBS, it's attaining a very high efficiency, much higher than its peers. But on the other hand, if you examine their SGD balance sheet, right, you can see the DBS LDR for SGD is much lower than its peers. Right, this means that it has the most liquid SGD balance sheet. So if we combine them together, okay, but we can conclude that DBS is best positioned to benefit from rising interest rates, attaining great efficiency, yet still maintaining the most liquid SGD balance sheet. Right. Now moving on to the second investment merit, right? DBS has been showing very good traction from their Hong Kong side, right? Growing the profit before tax quite nicely, right? So it has the best exposure to Greater China, which is what is driving their general commerce loans growth, right? From trade flows, it's coming from China into Asia, right? So since we are quite optimistic on China's economy going into FY14 to the medium term, we think that DBS definitely stands to gain the most, right, in the presence of China compared to the other two banks. The third investment merit on the valuations portion, you can see that DBS still is trading at a discount to its peers, which is trading between 1.4 to 1.6 times PB. Right, the ROE profile for DBS is improving, and their earnings is gaining very good traction as well over the last few quarters. So we think that the valuations for DBS is quite undemanding, right? And that forms up our third investment merit, right, where DBS is still trading at a discount. We see upside for that. Some of the key risks for DBS, again, the Singapore banking sector moves quite in line with STI, right? And increasing interest rates, right, might drive up worsening in credit quality. So that could possibly drive up the credit costs for our banking sector and DBS, right? FX depreciation, like we have discussed earlier, as well as a weakening of the Asian economy. So last of all, to reiterate on DBS, right, remains our top pick for the Singapore banking sector. Maintain accumulate with a target price of $19.09, new target price. Right, 4 investment merits, standing to benefit the most from rising interest rates. The best exposure to Greater China through their DBS Hong Kong. Valuations is still trading at a discount to its peers and maintaining a very attractive, stable dividend yield of 3.3%. So with that, end of the presentation on the Singapore banking sector, as well as a quick one on DBS. So please feel free to ask any questions. We have a question on what is NIMS. NIMS are the net interest margins, which is the net interest income over the total interest yielding assets, right? So it's quite a good measure of how much your interest bearing assets is able to generate net income for you. So it's quite one of the key metrics that we use to measure how profitable the banks are performing.
We have a question on which sector and industry will be the leading ones in 2014. So that would be the banks, which we have covered today, industrials, and we have our top picks there in industrials would be Cabell Corp and Balsted. And we also think consumer discretionary, especially those related to travel, will probably do well as well. And we have coverage of Intercontinental Hotels, Amara Holdings for a local one, and we also have Iconics Brands, a US listed stock. Okay, the drop in FNN is due to a distribution in specie. Please comment on the STI market situation right now in terms of the indices. We actually think the STI will probably do better than the rest of its Asian peers going into 2014 because, as you know, there are problems in Thailand and Indonesia, and Singapore is seen as a defensive market. And given in your overall Asian portfolio allocations, then you would be, I think most managers will be picking the STI over Thailand and Indonesia. The other one that will probably do well is Malaysia. Actually, it looks more like the defensive Asia that will outperform in the coming year.
Okay, we have a question on how much in terms of percentage of Singapore Bank's earnings are from mortgages. Right, the percentage of earnings are not actually disclosed by the banks in terms of the mortgages, right? But for the loans mix-wise, ranges from bank to bank. Okay, so it usually consists about 25 to 30% of the loan mix for mortgages. Right, the next question on any figure for gauging when using the net income is actually net interest margin. All right, for NIMS, right? There's no benchmark figure, right? But we know that for Singapore banking sector, it generally ranges from high 1.6, right? So 1.6 to 1.7 for 3 banks, depending on the exposure to which markets, right? So, of course, let's say if you examine the NIMS beyond Singapore, like for example, let's say if you look at Malaysia or Indonesia, where interest rates environment is higher. So the banks which disclose the NIMS for these sectors is generally higher over there. But the NIMS is a combination of a lot of factors, both internally and externally. Okay, so onshore and offshore. So overall, the NIMS for the banking sector has went down quite a lot in line with a low interest rate environment, right? So potentially we see some upside from there as well because they are remaining quite stable, right? Okay, so how much risk for DBS if the Indian rupee depreciates, Indonesian rupiah depreciates, and Thai political situation escalates? So that's why we like DBS. Okay, fortunately, Indian rupee, we know that this is depreciating, and last time round they actually disclosed that there's some pockets of non-performing loans over in India. However, they're quite shielded from this because quite a big bulk of the India book, right, is they're actually denominated in USD. So it's not that much risk coming from the India side. And then for Indonesia, they don't have the exact figure on hand, but Indonesia exposure is quite low for DBS in comparison to OCBC which is much higher. And Thailand, probably UOB has the highest penetration to that. DBS, not much. So not that much of a risk for DBS. Okay, we have a question on the China liquidity crunch. How much impact there is for DBS? Right. Okay, for the China liquidity crunch wise, let's see again, okay, how DBS is actually exposed to China. Okay, DBS, right, China, the trade flows are coming out from China into Asia, right, because they're seeking for a lower interest rate environment away from China, so the cost of borrowing is lower. That is why so much of the loans from China, right, are actually USD denominated, because USD has been cheap, and that is why they are coming out of China and connecting to Asia from DBS Hong Kong. So hopefully the liquidity crunch shouldn't affect DBS results by too much. Right? What we are more concerned about is actually how well the China economy is going to do. Right? Because these will affect the trade flows that come out of China into Asia, into ASEAN. Right? So we think that China economy going forward should be pretty stable. Right? As the Li Keqiang's government has just stated that they are striving to keep the China economy and market stable. Right, so we see quite a good upside for DBS for that.
We have a question on our view on the healthcare sector. Sorry, we actually don't have any coverage on the healthcare sector right now. And there's a question here on the recent high volume healthcare shares. Sorry, we also don't have coverage on that. Okay, for exposure to China, any recommended ETF listed on the SGX? That is the SSE 50, which is a UOB ETF. Hi, for the outlook on REITs, we are not positive on the REIT sector due to rising interest rate environment, and that means REITs will be priced lower.
Right, so we have come to the end of our weekly webinar. So wishing you a very happy new year, and we will see you again next week. Thank you.